Index funds have become a cornerstone of modern investing, offering a simple and cost-effective way to grow wealth. These funds track the performance of a specific market index, like the S&P 500, providing instant diversification across numerous stocks or bonds. Their popularity stems from low fees, ease of management, and consistent long-term performance, often outperforming actively managed funds. Today, we will talk about understanding index funds and why they're popular. So, before we start, make sure to hit the like button and subscribe to my channel. What are index funds? Index funds are a type of mutual fund or exchange-traded fund, ETF, designed to replicate the performance of a specific market index. A market index, such as the S&P 500, NASDAQ 100, or Dow Jones Industrial Average, measures the performance of a group of securities representing a particular segment of the financial market. Instead of being actively managed by fund managers selecting individual securities, index funds passively track the components of an index. For instance, an S&P 500 index fund will invest in the 500 companies within that index in the same proportion as their weighting, aiming to match the index's returns rather than outperform it. How index funds work. Composition and tracking. Index funds mirror the composition of their target index. For example, a fund tracking the NASDAQ 100 will include shares of technology-focused companies such as Apple, Microsoft, and Amazon. This passive approach ensures that the fund's performance closely aligns with the index it tracks. Automatic rebalancing. As markets fluctuate in companies within an index change, index funds adjust their holdings to stay aligned with the index. This automatic rebalancing ensures the fund maintains its intended strategy without requiring active intervention from investors. Cost efficiency. Because they don't require extensive research or frequent trading, index funds have significantly lower operating costs compared to actively managed funds. This cost efficiency translates into lower expense ratios, making them a budget-friendly choice for investors. Why index funds are popular. Diversification made easy. Index funds provide instant diversification by spreading investments across a broad range of securities. For example, an S&P 500 index fund gives exposure to 500 of the largest companies in the U.S. economy. Diversification reduces risk by minimizing the impact of poor performance in any single stock or sector. Low expense ratios. One of the standout features of index funds is their low cost. Actively managed funds typically charge higher fees to compensate for the expertise of fund managers. In contrast, index funds simply replicate an index, reducing the need for active oversight. For investors, this means more of their returns stay in their pockets rather than being eaten up by fees. Consistent performance. Research consistently shows that most actively managed funds fail to outperform their benchmark index over the long term. Index funds, by design, match the market's performance, which historically trends upward over extended periods. This consistency makes index funds a reliable choice for achieving long-term financial goals. Accessibility for all investors. Index funds are straightforward, making them ideal for both novice and seasoned investors. Many index funds require low minimum investments, and ETFs can be purchased in fractional shares, making them accessible to individuals with limited capital. Tax efficiency. Index funds are generally more tax efficient than actively managed funds. Because they have lower turnover rates, fewer trades within the portfolio, they generate fewer taxable capital gains. This makes them a tax-friendly option for investors looking to maximize after-tax returns. Common types of index funds. Stock index funds. These funds track the performance of stock indices like the S&P 500, Russell 2000, or NASDAQ Composite. They offer exposure to a variety of companies across different sectors and sizes, catering to investors with a focus on equity markets. Bond index funds. Bond index funds track indices like the Bloomberg U.S. Aggregate Bond Index, They provide diversification in fixed income securities and are ideal for risk-averse investors seeking steady returns. International index funds. These funds track indices of global markets, such as the MSCI World Index or FTSE All World Index. They allow investors to diversify geographically, gaining exposure to companies outside their home country. Sector-specific index funds. Some funds focus on specific industries or sectors, such as technology, healthcare, or energy. These are suitable for investors with a strong belief in the growth potential of a particular industry. Advantages of index funds. Simplicity. Index funds eliminate the need for active stock picking or market timing. Investors can simply choose a fund that aligns with their goals and let it grow over time. Predictability. Since index funds track well-established indices, their performance is predictable relative to market trends. This reduces the uncertainty often associated with actively managed investments. Long-term growth potential. Historically, markets tend to rise over time despite short-term volatility. Index funds harness this growth potential, making them an excellent choice for long-term financial objectives like retirement or education funding. Disadvantages of index funds. Lack of flexibility. Index funds cannot outperform the market because they are designed to replicate it. During periods of market downturns, they will follow the index into negative territory, offering no opportunity to minimize losses through active management. Limited customization. Because index funds are tied to a specific index, investors have limited ability to customize their portfolios to reflect personal preferences, such as avoiding certain industries or ethical concerns. Exposure to market fluctuations. While index funds provide diversification, they are still subject to market risks. When an entire market segment performs poorly, an index fund tracking that segment will also decline. Over-diversification. Some critics argue that index funds spread investments too thinly, including underperforming or stagnant stocks alongside strong performers. This can dilute potential gains compared to more targeted investment strategies. How to choose the right index fund. Determine your investment goals. Whether you're saving for retirement, a down payment, or short-term needs, your goals will dictate the type of index fund to choose. Assess the expense ratio. Look for funds with low expense ratios to maximize your returns. Even small differences in fees can significantly impact long-term performance. Evaluate performance history. While past performance is not indicative of future results, reviewing a fund's historical returns can provide insights into its reliability and alignment with its benchmark. Understand the fund's holdings. Ensure the fund's composition aligns with your investment strategy. For instance, if you want global diversification, opt for an international index fund. Consider tax implications. If investing in a taxable account, choose funds known for tax efficiency to minimize your tax burden. If you like this video and would like to see more like it, please give it the thumbs up. Leave a comment and click the button to subscribe.